Welcome to This Is Money podcast. I'm Georgie Frost, and joining me and Simon Lambert today is Lee Boyce. And coming up, a plan to revive our stagnant economy. Hand every kid £1,000 to invest in it. Simon explains all and looks at ways you can invest for your little one's futures. Also today, Santander launches a Best Buy Easy Access account, paying 5.2%. But it's not the only bank offering blockbuster rates. Lee gives us a rundown. Are we nearly there yet on the base rate? The Bank of England governor says maybe, but we probably aren't there yet on falling house prices. And why are electric cars suddenly getting so much cheaper? Is it time to buy? Don't forget, you can stay up to date with all the latest breaking money news. Just go to thisismoney.co.uk or download the app.
Don't forget, you can stay on top of what's going on in the markets by tuning in to the Digest and Invest podcast by eToro. Go to your regular podcast platform and listen on the go. Digest and Invest by eToro, the podcast for those interested in trading and investing.
But first, every child could receive a pot of £1,000 at birth. This all sounds rather familiar, doesn't it? To be channelled into long-term investments in UK growth, under proposals to revive our stagnant economy. Now, the idea of a new generation trust is part of a package of reforms that could add £225 billion to the economy. So says a report by the City of London Corporation. It revives memories of the Child Trust Fund scheme launched by Gordon Brown 2 decades ago, if you remember, and later scrapped by George Osborne. So Simon Lambert, there's a lot to unpick in this one. Not so much on the detail of how we're going to fund giving every kid £1,000 to then invest in the UK economy, but give us a bit of context. What is this about? Who are the City of London Corporation?
The City of London Corporation is an organisation that represents the City of London. The City of London obviously has finance at its heart. It's not a financial organisation. It represents the City of London, that area of London. But obviously what has been key to the city's success over hundreds of years has been London's very strong reputation for finance. And they have come up with this idea, along with a number of other ones, that involves giving every child £1,000. It would be a pot for them to invest, and it would be there for their future. So if you gave every child £1,000 at birth, and then they had to wait until they were 18 to be able to access it, at which point the money would move into even an investment ISA or into a defined contribution pension, which is the idea, then hopefully with the benefits of stock market growth over the years, they would have a nice little pot by the time they reached 18. It does kind of revive memories of the Child Trust Fund, though, doesn't it? As you mentioned. But it doesn't mean it's necessarily a bad idea. I think there is one thing, obviously, to mention about the City of London Corporation is that whilst they are an organisation that represents the City of London, I don't believe they are also suggesting that they would pay this £1,000 per child.
No. Okay. Is it likely? Is this just one of those reports that people sort of bash out and that's nice, but actually nothing's going to come of it? I mean, how will it be paid for?
Well, there's a double angle to this because obviously this is an idea that would create long-term investments and savings for young people. And actually, if you think about it, there is a lot of merit to that. A lot of policy over recent years has been skewed towards older people. We have a story today talking about how much the state pension triple lock has added in value to the state pension. The IFS has calculated £1,200 a year boost to income, but has also said that it brings insurmountable pressure to raise the state pension age faster. Ultimately, we have an ageing population. We have made a commitment to them on pensions that is expensive. We also had the COVID years in which young people suffered more than older people, and it was skewed towards protecting older people, which was, I'm not saying it was the wrong or the right thing to do. Protecting older people was definitely the right thing to do, just to be clear. But younger people have lost out. Younger people face much higher house prices than earlier generations, a much higher multiple of earnings. They don't benefit from the same employment security. They don't benefit from the same higher value pensions that their employer is committed to providing them with. They will have to invest their money themselves to build up their pension for the rest of their lives. Many people question whether younger generations today, and by that I mean like people all the way down from their 40s, under will ever be able to build up the same amount of lifetime wealth that their parents' generation did. So you can see why policies that say, okay, well, let's just try to give, even if we're missing out the people who are already there, let's just try to give kids born from this point on a leg up. You can see why those are attractive. And it could happen. A government could adopt this policy because whilst the City of London Corporation, it can't decide that everybody's going to get £1,000. It's floating an idea. And a lot of these ideas come from think tanks or organisations or things like that. But the double angle to this is that it would be used to invest. And it says in doing so, the government would be providing a source of long-term capital to UK businesses. It could also help to build an investment culture in the UK. That obviously depends on that money being invested in UK companies, though.
Mm-hmm.
I mean, is there going to be a restriction that you could only invest your £1,000 into UK stock market listed companies? Because if you invest across the way that the global stock market is set up, 60% of it's going to go into backing US companies because the US market makes up about 60% of the global stock market. So there are a number of things to unpick here. But there is also this big desire to try to get more investment going into UK companies and actually not FTSE 100 UK companies, the ones further down the scale, the 250, the 350, the AIM companies, the unlisted companies. And that led to some pension changes recently, which will allow pension funds to invest more money into smaller, riskier companies, which the government said is going to make everybody much, much richer in retirement. And were slightly dubious figures. But that's where these two angles are coming from with this idea.
So in terms of our survey says to encourage people, firstly, to invest, one aim, and the second is to invest in the UK economy and therefore revive our stagnant economy. Potential? These sorts of ideas? Are we sort of scratching around in the dark here for anything to help?
I think that the problem is actually, if you go back to the Child Trust Fund thing, the problem with a lot of that Child Trust Fund money is that people didn't engage with it properly. It just ended up sitting in really low grade cash Child Trust Fund accounts when actually the idea behind it was really that they should be investing it. So maybe, I mean, if you did something like this, you just remove the option to have it in cash. You don't have like the old Child Trust Fund investing, Child Trust Fund distinction. It's all got to go into investments because ultimately people are used to doing that. You don't pay your pension contributions into your pension and then your pension goes into cash. You don't have your pension provider saying, would you like to put it in a cash savings account or invest it in the stock market? It gets invested in the stock market. You get some help along the way and you get nudged to do it. And if you're really active with your pension, you could find a money market fund and you could put it into cash. Although with many work pension schemes, you'd find that quite difficult to do because they don't tend to offer those funds. But maybe you just channel it all into investments. And that would be a good thing. It would be a good thing for the people whose money it is, because over that 18-year period, that is a long enough period that you should benefit from really good stock market growth and the dividends that you get, and you reinvest the dividends. And that's actually a really powerful driver of building long-term wealth. And you should not only beat inflation, but you should get a good return. You'd be very unlucky to get an 18-year period where you lost out by investing. Can you get those people to only put it into UK companies in a way that benefits those UK companies? I'm not so sure. That would suddenly become much more restrictive than saying to people, you can't put it in cash, you can only put it in an investment. But, maybe you could. If you're giving people the money, maybe you can restrict what they can do with it in such a way.
I'm seeing the headlines.
But you would get lots of stories, just to warn you, in the financial press saying, if only you'd let these children invest in the global stock market instead, they'd have made X% more rather than investing in the UK. I mean, you might be wrong. The UK might outstrip the global stock market for the next 18 years, and that would be great. But you are narrowing it down quite substantially. And if you take investment theory, you are taking a really, really big home bias there that means that you are straying very, very far from what the market is.
Which may be encouraging people to invest, but probably not in a way that you would advise them to do so. Lee, Simon's mentioned child trust funds a couple of times now. Just take us back, if you would. Like, What were child trust funds all about? Why are they no longer here? Why were they scrapped? Because this does seem like, to get the exact figure, £1,000, does seem that they've obviously looked at this, the child trust fund scheme, and thought, oh, actually, we could do something with that. So could you call it a success, even if it's not here anymore?
The big problem with the child trust fund scenario, Simon says, it's just been such a lack of engagement to the point in which we've had the first tranche of adults, kids that are turning into adults have been able to access them since September 2020. But there's a lot of kids out there who are sort of 16 to 18 who are sitting on this cash. They've got no idea what it is. So basically, these were vouchers that were issued to every single child that was born. It was launched in 2005, but every child born between the 1st of September 2002 and the 2nd of January 2011 was given a voucher for £250. And in some instances, children got an extra top-up of £250, depending on the financial circumstances of the families. Now, this suggestion of £1,000 going to every single child, I mean, there's roughly 700,000 children born every year in the UK, so that would be a £700 million bill. We don't know how that would be financed, but actually, in the grand scheme of things, that isn't absolutely astronomically massive.
Yeah.
So you look at it from that point of view, but it's still got to be paid for somewhere. Is number one. I don't absolutely hate the idea, but I think in order to make it work, you would need essentially it to be almost like gamified. Does that make sense? So in order for children to be engaged in this money as they get older, I'm talking about secondary school age, I'm almost thinking like you've got to log into this. Kids love logging into apps.
Like Moneybox style.
Exactly,
kind of stuff.
exactly.
Yeah.
And it has to be engaged with. And if it isn't engaged with, you get some sort of penalty. And you have to make some sort of like slight decisions with it in terms of risk and that type of thing. But it gets complicated. How do you kind of administer that? How do you set up a savings or investment provider that's going to want to manage that? Gets very difficult. Or do you then say, well, hold on, what about if we went somewhere like LS&I, and it went into like green projects, for example? We're on this big push about everything going green and eco-friendly and parents worrying about their kids' future and all that kind of stuff. Could you look at it from that point of view? But fundamentally, when I hear something like this and look at something like this, I think CTFs have been a massive flop. I think the engagement on it has been absolutely rubbish. I think lots of kids under the age of 18 to 21 still haven't claimed this money, got no idea where it is, where it exists. It's actually quite easy to find it. So if you do have a child who has reached adult age or is basically 18, 19, 20 or 21, they can go and have a look at this. All you need to do is fill in an online form for HMRC. You will need to have a government gateway, which is 2 words that might fill anyone listening to this with dread. But you can track it down that way, and with your national insurance number, and you should be able to find this pot of cash. Your adult child might have some money. You might be even of that age listening to this podcast, going, "Oh, actually, maybe I have got a pot of cash." The lack of engagement has been absolutely astronomical. I think the other thing that I kind of think about this, and I have mentioned this in the podcast before, I think parents have a responsibility to be saving for their children. Now, I know that's not necessarily easy for everyone, and there'll be people listening to this podcast going, I haven't got a spare X amount per month to put away for my child, but there'll be other people out there that do have the disposable income and can tuck away bits and pieces of money. So I've been saving for my daughter, who's about to turn 5, since February 2019. So it took me a couple of months after she was born, but got it opened. Opened it with £1,000 that we had stashed away. Wife and I put 75 quid a month into an investment account, saving into my own adult ISA allowance, because I'm never going to breach 20 grand. You can save into a junior ISA. You have a smaller limit of 9 grand, again, that most people wouldn't breach, but your child will have access to that money when they're 18. I had a quick check actually before this podcast to see how that was doing. I've got it in a 100% equity fund with Vanguard. The return at the moment is at 40.2% since February 2019. And it's building up nicely. And I crunched it through compounding calculator with £1,000, assuming 5% interest, 150 quid a month going in over 21 years. So I've got no plans on this money going anywhere before 21. With 3%, that pot would be 54 grand, 3% growth, 5% growth, 70 grand, 8% growth, 100 grand. Now, I re-crunched the figures if you started from zero, so you didn't have £1,000 to start with, and you put away 50 quid a month. So £25 potentially between you and your partner, or a grandparent who might want to help out, or any other relative, or that kind of thing. 3%, this again over 21 years, that'd be 17.5 grand. 5%, just over 22 grand, and 8% just over 32 grand. I mean, I think that should give anyone motivation to think, I'm going to do it. And let me give you another example. I was in a shop with my daughter the other week. Now, you had all this ban on like sort of putting junk food near the tills, so like chocolate and sweets and all that kind of thing. I think there's something that's actually worse than that. And then those magazines that have all those plastic tat, colourful magazines with plastic tat, can never see the price on them. Daughter begged me for one last weekend. We took it to self-checkout. $7.99
Wow.
for the magazine with some plastic tat in it. And I thought she was going to kick off when I said, I'm not buying that. I'm really sorry, but that is too much money. And she actually was fine with it. But that kind of thing, that kind of pressure buy, you think 8 quid to put that in, I'm not going to say I'm going to put that into your pot, but it's almost like there's a lot of waste when you're a parent. There's a lot of pressure from children to get this, that, and the other. And just a small little cutback on something that could get funneled away for their future. They're not going to thank you for it now. Of course they're not. There might be some tears and tantrums, but it can be well worth doing. And even if you do go into a junior ISA rates have gone up massively as well, so you can get 4.95% on an easy access now of a junior ISA. That's not to be sniffed at, Georgie. And I think that there's parental responsibility. And unfortunately, I think the CTF situation in which the vast majority of parents have not engaged with this pot, I would think I'd be, we do what we do, so I would be engaged in that pot of cash and making sure it was doing something that's working hard for my children. But a lot of people just don't really think like that, and it's hard to force them to think like that. So, you give them £1,000, what are they going to do with it? Is it actually going to be helpful? Is it going to be invested?
I was going to say, Lee, you've crunched some amazing figures there, but that's dependent on you adding money regularly for your child. How much if you just whacked in £1,000? Okay, Simon's putting his hand up here. Yeah, it's not school, Simon. You can just crack on in there. I know we're talking about kids. How much would you get if you just put in £1,000? And also bearing in mind inflation and all that sort of thing. Could it buy a weekly shop at least?
Here's the maths.
If
you put £1,000 in and it was invested for 18 years and you managed to get a 6% average annual return, which is high, but that's not that high, to be honest, for stock market returns. That's probably, you might be hoping for more than that, to be honest. But you might get less than that. So 6% is a reasonably fair number to go for. Your child would have £2,936 at the end of it, which doesn't sound like that much, does it? I mean, they've nearly trebled their money. When you put it in that context, then it suddenly is like, okay, trebled their money. But as you say, you've got to allow for inflation. But if you look, again, as I've said many times before, if you look at the figures, investing is the best way to beat long-term inflation over time and so on. The real return, you might get a real return of 6%, to be honest. That's not that far off the average real return of the FTSE. So, or the average real return of the global stock market, for example, is better. So you could get a real return of 6%. So that could be the equivalent of £3,000 once you've factored in inflation. But I think, to go back to Lee's point, there's something that you can do here that makes a phenomenal difference. So if you put £50 per month in, only £50, now £50 might be too much because people might think, well, I need to put the £50 into my own savings. But say you go for £50, right? So two parents putting in £25 each, or maybe just one parent having to put in, £50? That is a game changer, because all of a sudden your return after 18 years goes from £3,000 to £22,304. Quite a big difference, that, isn't it? Even if you could only get £25 a month in, it turns it into £12,620 instead of £3,000. And this is something that illustrates two things. One, the power of compounding, but B, the power of regular investing or regular saving. It makes a phenomenal difference Obviously, you've put more money in, and actually 25 times 12 times 18 is quite a lot of money that you've put in. But that, if you can just get that little bit of money in, it makes a real difference. And to go back to what I was talking about, younger people, suffering in a way that others, the older generation hasn't, from not having as good pensions and things like that. You can grumble about that and you can moan about that, or you can accept that unfortunately that is just the way it is and you need to do something about it yourself, which is why when you get auto enrolled into that pension, don't opt out. Put in as much as you possibly can to benefit from your employer's contributions. So they will maybe match it. They will add a certain percent. If you put a certain percent in, they might even more than match it. Make sure you're putting in as much as you need to get the maximum that they will give you, because otherwise you're turning down free money. Remember that the money you put in automatically gets a 25% boost, thanks to, tax relief. And then remember that over a really, really long period of time, it will make a huge difference to what you have in retirement. So let's go to somebody who puts in £200 a month into their pension, and they do it for 30 years and they get a 6% return. So 30 years, they don't start until they're age 35 and they do it until they're 65. They would end up with £201,000. Now, if they started when they were 25 instead, they'd end up with £400,000. So basically, pretty much twice as much money. That's going to make a huge difference to the retirement that you get at the end of it. So if you're listening to this and you're in your 20s, put that money in your pension, because 65-year-old you will say thank you in 40 years' time that you did it instead of waiting until you were 35. And I know that probably that £200 a month is quite a lot of money for you and feels like quite a lot of money for you. But bear in mind, you're not putting the whole £200 in. First of all, you're putting in a certain amount and then your employer's probably matching it. And you're also getting a 25% uplift on the money that you put in. So it won't cost you £200. It will cost you much less. And at some point, you in your 60s will jump in that DeLorean. It'll rocket backwards, and say, I'm having a great retirement. Thanks very much for doing that and not waiting another 10 years.
Here, Simon. Sage advice. So that's investing, Lee Boyce. It's been some week for savers. Simon there said about 6%, high but good rate of return for investing. But we've got 6.2% best rate fix from NS&I. Santander came bowling in, hot on the heels of that offering with their table-topping 5.2% easy access. And now Moneybox, we just mentioned earlier, are offering a best buy rate of 4.65 for an easy access ISA. Lee Boyce. Exciting times.
Welcome to Lee Boyce's Savings Corner. Yes, it has been another quite exciting week for savings rates, actually. So we spoke about the NS&I one last week at 6.2%, the fixed rate. So one of the areas of savings that have actually suffered quite a bit from the Bank of England report I was talking about last week, about where people were taking money out and putting money in. Fixed rates have done very well. Cash ISA has done very well. Easy access, people have been pulling money out left, right and centre. Just because they haven't been keeping up. All of the interest has been in fixed rates and cash ISAs. But this week, Santander, a rare move from a big bank, has launched the Best Buy Easy Access by quite some way at 5.2%. It's open to new and existing customers. Finally, we have an easy access rate that's quite solid over that 5% mark. A couple of things to sort of warn about this, though. After it's a 12-month rate, so after a year, it falls to 1.05%, which is just absolutely astronomical drop that you will need to set a reminder on and make sure that you're moving your cash away after a year. The other thing is they're saying that this is limited edition. It sounds quite exciting, that doesn't limited edition savings account. And they said it will only be on sale until the 17th of September. Could be pulled quicker than that, though, depending on how much interest there is in it. Wouldn't be surprised if it goes before that, just because it really is a market leading account. So we had that. Exciting start to the week. Lots and lots of excitement over that. And if you're part of our savings alert system, which is at thisismoney.co.uk/alert, you would have been told about that account within minutes of it coming out. So do get signed up to that email. There's almost 17,000 readers are now.
What is it?
It's /alert. So this is money.co.uk/alert. Georgie, you typing it in now and getting yourself in there. Yeah,
that's exactly what I'm doing.
Wow, that's brilliant. You can get alert to these rates straight off the bat, so you won't miss out. In the cash ISA stakes, it's been relatively quiet, and there's always a gap between what the best cash ISAs pay, both for easy access and fixed rates, compared to non-tax-free accounts. It's because there's not as much competition, not as many providers offering cash ISAs, just because of the red tape involved. It's a little bit more of a faff for providers. But Moneybox, which started life in 2016 as an app that rounded up people's savings, but has branched out into other areas, including this week launching its first cash ISA, has come up with a nice rate of 4.65%, which again is market leading. That includes a bonus of 0.85%. You need to have more than £500. It accepts transfers in from other ISA providers, but you have to open the account with an app. There's no other choice. Santander, the easy access account, that's open online, in branch, on phone, post. Quite an unusual one that it's available in all different kind of methods. This Moneybox one is an app only. There's nowhere else you're going to be able to get this account. And again, we've touched on this quite a bit in recent months, but with that 5.2% easy access from Santander, you must be aware of the personal savings allowance and whether you're going to breach it or not. Obviously, with cash ISA, you have that £20,000 annual limit, which is more than enough for the vast majority of us. And just for a little bit of bonus banking content for you, Georgie, First Direct came out with a bit of an unusual one this week as well. So current account switching. Actually, most of the current account switching offers have been pulled. There's only 2 left. So NatWest are offering £200. First Direct are offering £175 and have done for quite some time. But this week they've done something that I've not seen actually when it comes to a switching offer. They're offering almost like a premium bonds-esque product here. So if you switch your account with them using the current account switching service before the 1st of October, and you haven't been an HSBC customer or haven't switched HSBC, I think since the start of since 2020, and you haven't been a First Direct customer before, you'll be entered into a prize draw to win one of 5 sums of £12,500. Again, not to be sniffed at. I don't know if that's. I think what's happening in the current account switching war is that a lot of people are getting numb to the kind of here's £175 or here's £200. It's kind of like a lot of people now have switched around and done that and banked the cash and all that kind of thing. And I think that banks are having to come up with kind of more intuitive ways to try and hook people in. So one thing that's definitely happened in the last 12 months, the payout has got much shorter. So typically you'd be waiting at least a month if you hit all the criteria. I mean, some of them are offering it within like 3 days, 7 days, that kind of thing. So that's been one thing that's happened. And now this week, First Direct have gone with this kind of move. I'd expect between now and the new year, there might be more of these kind of, I'm not going to say gimmick, but a bit gimmicky ways of trying to hook new current account customers in.
Well, maybe they're going for the gamification that you're talking about. Like, that's the way to do it, isn't it? Simon, sorry?
I was going to say, I think it's quite an interesting move from First Direct because it's First Direct, and First Direct, has always offered these switching. Has long been one of these banks that's offered a switching bonus, and was pretty much at the forefront of that. But it's interesting that it's going down this price draw route and it's doing it. And I wonder whether it's because a little bit of the gloss might be coming off First Direct. I don't know how many people.
What makes you say that, Simon?
First Direct has always been renowned for its customer service, right? You pick up the phone, you speak to somebody, who knows what they're talking about. In this country, they deal with stuff pretty fast. But there's been some grumblings from customers in recent times about First Direct's customer service and that it not being what it used to be. And First Direct has faced a challenge from new banks who have come along. It used to be the new bank. It used to be the online and phone bank. That was its big thing. But you've now got things like Starling. Monzo as well is very popular. Starling's app. I've got a Starling app. I've got a First Direct app. Starling's app absolutely knocks First Direct out of the park. It's
Yeah.
like Starling calling up First Direct and saying, "Hi, yeah, the 2000s are calling. You got an app there? We've got one that does all this fancy stuff." First Direct, you can't label your payments in the same way. You can't do some of the things that make that app much more useful to you. You've then got rivals like Chase, who have come in and proved very popular, offering people good rates on savings and things like that. You've got Santander pushing its latest version of its kind of cashback and in credit interest account and stuff like that. And I just wonder whether, maybe First Direct is having to go down this prize draw route, because it's just, maybe it's not quite got the draw that it once had.
Very interesting. That's it for part one.
I'm joined now by Sam North of eToro for our weekly look at what's been happening on the markets. Sam, how's the past week been?
Yeah, markets in the States have been moving lower, which I guess for people that like that seasonality trade, it's not too much of a surprise. Of course, September, the worst month from a seasonal perspective in the year. Higher US 10-year yields and also a $90 oil price haven't helped that. However, there has been some winners this week. Japan and China have both boosted, and also oil and oil-related companies such as Exxon and Chevron have had a pretty good week thanks to that higher oil price. Elsewhere this week, we've had our first cut in Europe, Poland. The first one there, one to keep an eye on, whether others will follow. We also saw Airbnb and Blackstone join the S&P 500. Apple had its biggest two-day decline from a market cap perspective, following reports that Chinese government workers have been banned from using iPhones. All in all, a pretty busy week, especially when you consider on the Monday there was a bank holiday.
And what do we have to look forward to next week? Is it another busy one?
Yeah, I think so. I've got four things written down. Number one, macro focus wise, we've got the latest inflationary print out of the States from August, and then also the latest ECB monetary policy decision. So from a macro point of view, we'll keep an eye on those. Secondly, we've got the latest Apple iPhone launch, number 15, so keep an eye on sales there. Thirdly, a couple of earnings out of Oracle and Adobe, worth keeping an eye on. We really are at the back end of earnings season, of course. And then the fourth point is quadruple witching, which refers to the expiration of stock index futures and options and stock futures and individual stock options. It's a pretty hectic day in the market. Volume can pick up a little bit, volatility too. So yeah, all in all, a pretty busy week.
And from that macro point of view that you mentioned, there's obviously this kind of hint coming out of the US, and then even a little bit of a hint in the UK from Andrew Bailey that we might be near the top. That our investors are keeping a close eye on that one, aren't they? Yeah,
absolutely. It does feel like we're very much near the peak, which hopefully, the inflation number in the States goes lower. I mean, if that surprises massively to the upside, things can change. But at the moment, it does look like we're nearing peak rates, which is great.
And anything other than that is the thing that will upset the apple cart.
Yes, absolutely.
Okay, thanks very much, Sam. We'll speak to you next week.
Thanks, Simon.
Welcome back. So talking of rates, are we nearly there yet with the Bank of England rate rises? The Governor, Andrew Bailey, has been speaking in front of MPs at the Treasury Select Committee, and what did he say?
Well, firstly, he delivered some good news in that we might be near the peak for interest rates. The Bank of England potentially has decided that it has now raised interest rates by so much, 14 times in less than 2 years, from 0.1% to 5.25%, after all those years of sitting on its hands, worried that it couldn't even inch interest rates up by a quarter point. It's decided that it can go totally bonkers and send them sky high to try and bring inflation under control. Inflation that many people argue the Bank of England was totally asleep on its watch as it started to occur. There have been some problems with raising interest rates, in that it's great news for savers, although they are still not earning a real return on their money because the Bank of England and the government have allowed inflation to get so high. But the good news is that in the future, inflation will come down. They should start earning that real return on their money. But it's not very good news for anybody with a mortgage. But most people are protected by their fixed rate mortgages, and then all of a sudden they get a payment shock. The Bank of England has come under some criticism because there is a suggestion that it has now raised rates so quickly and not taken into account the fixed rate mortgage scenario that this stuff hasn't fed through yet. And also that it is taking something of a toll on a chunk of the home owning public that, again, once again, veers towards that kind of younger generation, not the older home owning generation that don't have the mortgages and things like that. Anyway, the good news is we might be near the peak. The bad news is that the Bank of England also indicated this week that interest rates might have to stay higher for longer. I mean,
how much longer? Just longer.
Who knows?
Yeah.
I mean,
Yeah.
just literally, who knows?
Yeah.
That's not necessarily a bad thing. Getting back to a scenario where interest rates were around the kind of 5% mark is a goal, should have been a goal that we enacted reasonably soon after the financial crisis, so that we didn't have incredibly cheap money, completely skewing financial markets. Getting them from 0.1% to 5.25% in such a short space of time, possibly not the wisest of moves, but it'll all come out in the wash eventually, and it's really hammering quite a lot of people's finances. But the problem is for people hoping that we would hit a spike and then they would come straight back down, and that actually they're sitting there going, well, I don't have to remortgage now, but I've got to remortgage in 2 years' time. Hopefully rates will have fallen back by then to round about 2%, so I won't end up paying much more than I'm paying right now. I think that most of those people in that position, which includes me, are going to be disappointed and discover that, in 2 years' time, interest rates are still going to be knocking around a higher level. Whether they'll be as high as they are now, who knows? But it's impossible to predict these things. And you get, in the story we have that markets were predicting the base rate was going to peak at 5.75%. But not so long ago, markets were saying base rate was going to peak at 6.25%. And not so long before that, markets were saying that actually maybe at 4.75%, base rate had gone as high as it was going to go. So these things swing around substantially. But the important point to make is that over in the US, the Federal Reserve has indicated that it might pause at the next meeting. And that could be the top for rates in the US. And that's really important to what happens to rates in other countries as well, because the US is the largest economy, leads the way, and all that other stuff. So there is a bit of hope. And actually, we are seeing mortgage rates come down.
We are. We saw them coming down 0.2%, like really quite slowly. But I've sort of noticed that it's even slower now than they were. Is that because lenders are anticipating what might come down the line? Or perhaps because we've had two house price figures that actually say pretty much the same thing. Wow. That was the Halifax and Nationwide saying that house prices have seen their biggest slump since 2009. Halifax saying average home falls £14,000 in a year. Is this lenders wondering whether house prices will fall further before they commit to slashing rates even more? Or what do you think, Lee? What does it all mean?
I think there's been some downward movement in terms of mortgage rates and some of the major lenders, probably from a competition point of view, in terms of there's not as many people buying homes. There was Zoopla research recently suggesting that housing transactions are going to be down a fifth this year compared to last year. So there is that element of still got to try and hook some customers in. But I think it's getting to that point now with mortgage rates where they're kind of settling to what is essentially probably going to be a kind of new normal for a while. And if you look over long-term averages, are kind of bang on average, and I think this is what we keep banging on about on the podcast, is that we have just come off of years of ultra low mortgage rates. So, having mortgage rates between sort of 4.5% and 6.5% isn't anything really extraordinary. And I think that's what's going on. And then you're right. I mean, two house price indexes, the two probably most familiar outside of the ONS with Halifax and Nationwide, both saying pretty much exactly the same thing. Hallelujah! I mean, wow! Believe it. They've got all their ducks in a row. We're all in sync. It's
what annoys me. Anybody who hasn't listened to the podcast for the past 10 years, just because there's a million a month and they're all different.
They measure it. I mean, to be honest with you, there more and more have kind of cropped up property price indexes, but the three that we really do stand up and take notice of tend to be Halifax, Nationwide, and the Office for National Statistics. And this Halifax index, as you say, drop of 4.6% in a year, the biggest annual fall since 2009. The big reason behind that is because the first sort of 8 months of last year, house prices were continuing to tick higher and higher and higher. Then we had the mini budget. Then we saw mortgage rates spiral. Then we saw house prices starting to massively cool, and that's now all being reflected in a report a year later. But it doesn't paint, and again, we've been talking about this, but it doesn't paint an entirely accurate picture regionally, because some pockets of Britain are holding up better than others. So the most resilient, according to the Halifax Index, is the Scottish property market, where prices are down 0.6% in the last year. So basically stagnant, they're basically flat. But then you have properties in the southeast, and they're down 5%. And then you got London 4.1%, Wales 4.7%, Southwest 4.4%. Very much the north-south divide, according to this research, and this Halifax data is very robust. It's all different around the country, but fundamentally, the house price falls in sort of London and the southeast are dragging it down that overall figure. How far they go lower, well, we did speak to some property experts, and it, of course it's hard to predict, but basically the majority are saying we expect further falls to be happening. But let's bear in mind that in the pandemic we had the runaway house price growth.
Yeah, we're still 20 grand, if not more, from where we were then.
I think what the worry is, and I think what the kind of the economists and the pointy heads are probably worried about more than anything, is people that have kind of overstretched to buy in that house price boom, particularly 2021 and 2022, that are going to come up to remortgage at far higher rates, potentially haven't had equity built in their home. So when a lender goes to revalue it, your LTV potentially, your loan to value potentially isn't going to have dropped. And then you start, those horrible words of negative equity start creeping in. That's the kind of, I think, the overall view of economists and the worry about these higher mortgage rates and house prices dropping. But these experts, some of them are saying, you could see drops of 15 to 20% further, in this cycle. House prices could fall another 10% this year. If mortgage rates remain above 5% in the next 6 to 12 months, we could see a fall in house prices of over 20% from peak. Adjusted for inflation, 30% by 2025. So there's quite a lot of doomsayers in the industry that are kind of worried that house prices are going to drop further. But on the other hand, as you say, the average house price, that average property price is still 20 grand higher than it was at the start of the pandemic. So there was inevitably, at some point, you would think a cooling of property prices, and it seems like that is coming home to roost now. That it seems to be reflecting in the house price indexes as it goes on.
A cooling or a crash, Simon Lambert, with all of your personal finance experience, where are we headed?
I mean, for a crash to happen, you really need there to be an element of forced sellers. You can have a transactions crash and not have a house price crash. And I mean, what defines a crash? 10%, 20%, 30%? I don't know. I mean, if you look at the long-term relationship between houses and wages, houses are way, way overvalued still. And the only thing that allowed that relationship to get so far out of kilter has been very, very low interest rates for a long period of time. If you go back to the pre-financial crisis days, which is where you have to go to find mortgage rates at this level, apart from in the sort of immediate aftermath of the financial crisis. When I bought my first flat, I took a 5-year fixed rate mortgage at 4.99%. And that was considered to be historically cheap money. That was a really good rate for a really good period of time. 5 years, 4.99%. That's a great rate to be able to lock into for 5 years. The mentality has totally changed since then. We've got I've got a 5-year fixed rate mortgage at like 1.4%. I was talking to somebody yesterday who's got a 5-year fixed rate mortgage at 0.93%, I think it is. I mean, it's like there's just complete switch about in the mentality to the point where a 5-year fixed rate mortgage at 4.99 seems expensive. But actually, not that long ago, it was relatively cheap. That's normal, not the bit that we saw after the financial crisis. The question is, does that return to normal impact the ability that people have to spend so much that a lot of that toppiness on house prices seen not just since the pandemic, but in the years before the pandemic has to come off? Or is the number of mortgaged homeowners now so small that it doesn't? There's a lot of cash buyers. It's cash buyers supporting the market at the moment. And there comes a point where people go, oh, that's quite cheap, actually. I'm going to, the people with the money go, that's quite cheap. I'm going to go buy. And when they think that's quite cheap, they don't think that's quite cheap compared to what it was 4 years ago. They think, oh, that's quite cheap to what it was a year ago. They anchor on the price a year ago. So actually, if you compare that price to what it was 4 years ago or 5 years ago, it would look more expensive. But they don't think about that. They think about what it was versus a year ago. Maybe human mentality is such that we won't see that crash unless you see the forced sellers. And the things that force sales are divorce, death, debt, right? So basically
all the cheery stuff, basically.
All the cheery stuff. This is Henry Pryor's line, right? Who's a buying agent, friend of This Is Money, expert in this stuff, has bought more houses than anybody will ever buy in their life in a year, basically. And those are the things that kind of drive that. And hopefully we won't see a scenario where you get loads of forced sellers, because nobody wants to see a scenario like the early 1990s, which was devastating for people. It wrecked people's finances. It wrecked some people's lives. They never bounced back from it. Nobody wants to see a repeat of that. What we do want to see, though, is a scenario where house prices are much more in line with wages than the absolute insanity that we have seen in recent years, because it would be really great if the housing market stopped being a casino.
Yeah, indeed. Right, well, it's not just houses, finally, that are dropping in price. Electric cars are suddenly getting a lot cheaper as well. So it's now the time to buy. Simon, you're the car expert. What's going on?
What's going on is there has switched from being an undersupply of new cars in the COVID years to do with COVID lockdown disruption, computer chip shortage, supply chain problems, impact of the war in Ukraine. Genuinely, there was like, for example, wiring looms. Who knew that lots of wiring looms for cars came from Ukraine? It caused major crunch in new car supply. There is now an oversupply of new cars, particularly electric cars. In fact, there is more electric cars than people want to buy. The undersupply had driven up prices in the used car market. The combination of now an oversupply in the new car market, along with the tax breaks you can get if you can buy it through a salary sacrifice scheme, where effectively if you're a high rate taxpayer, you'll get 40% off what you're paying due to being able to salary sacrifice it and then only pay a very small benefit in kind amount, mean that many people see buying a new one as more attractive. There's been a glut of electric cars landing on the market. Not enough people who want to buy them, because you've got people who do want to buy them, but then you've also got people who see them as more expensive, more hassle, and they just want to stick with what they got for the time being, which is where the education piece comes in on electric cars that I don't think we're necessarily achieving as a nation. And this has led to some substantial price falls. And in fact, actually, some of these cars look like a bit of a good deal at the moment, because there is the suggestion that maybe there might have been this like very, very steep price fall, and now prices are going to level out. So people aren't buying them because they're worried they're going to fall by another 10%, another 20%, another 30%. But actually, that's probably quite unlikely. So the 10 biggest fallers in the last year, the Peugeot E208. Okay, these are really quite good cars, actually. I've driven the Peugeot E208 a few times. It's good fun to drive. It's exactly what you would want a small electric car to be like. Average loss in price over the past year, 37.1%. So in October 2022, you'd have paid 580 for the average 1-year-old 10,000 mile example. Now you would pay £16,000. Hyundai Kona, 37.6% loss. Vauxhall Corsa E, down 37.7%. Mazda MX-30, down 39%. BMW i3, down 39.9%. The i3 is a bit of a underrated potential. Me and Rob Hull reckon the i3 might be the first electric car that becomes a future classic. You probably will lose money on it before that happens, but just to say, Hyundai Ioniq Electric down 40.8%, Volkswagen e-up down 42.5%, Nissan Leaf down 42.7%, Renault Zoe is a really good little car, really good if you just want a runabout to get around locally, or you don't regularly do really big journeys and don't have loads of stuff and a really big family to fit into it. Really, really good car. £21,600 a 1-year-old example would have cost you a year ago. You could now buy one for £12,000.
Wow.
So
wow.
That's nearly a £10,000 difference in the cost of buying that car. And then the Seat Me Electric, another small car, down 50%. And it's interesting, actually, that some of these big fallers are the small cars, the ones that people thought were maybe a bit more immune to it. But even the big ones, the really expensive ones, those have fallen by a huge amount. So an I-Pace, for example, down 34.4%. And once you start getting towards those higher price tag cars, the amount that you're actually saving on the cost of buying one compared to a year ago is huge. On the I-Pace, you'd be saving £18,470 on the average I-Pace for sale, which is immense. And that's, I think, almost the most you can save, apart from the Audi e-tron Sportback, which you could buy for £18,000, 929 cheaper than a year ago, or the Mercedes EQC, which you could buy for £20,275 less than a year ago. So it's not good news for anybody who bought one a year ago.
No. Tempted, Lee?
No.
Any reason, Lee?
Well, tempted to buy a used electric car. I don't need a car. I'm not in the market for one. I've got a very reliable petrol car.
But should you be?
Moment.
Should you be? Would
Should
you, if you're looking for your next car, would you want to do that, or are you on the side of a lot of people who just don't think that the infrastructure is perhaps ready? They're got range anxiety, all that sort of thing. Lee, just give us the final word.
I think I'd be tempted if I had a dedicated charging point on a driveway at my home, which I currently don't have. But I would investigate the cost of getting one of those installed and how quickly you can get that and how quickly it could charge an electric car up. I think that part of me that holds me back from potentially being interested in electric cars is that there's so much research and development going into the industry at the moment. All the manufacturers really are pouring in a lot of money into improving electric cars. I think that it's like any technology. I just feel like it's probably going to get better. And it's going to be a fair few more years. I don't want to. Listen, there's lots of choice out there, and there's a big premium though when you're looking at how much an electric car costs compared to like a petrol alternative, especially sort of like small hatchback first buyer type cars. I think it's quite a lot of money to be forking out. And also, I'll be honest, I have slight concerns about how green they actually are in terms of things like the battery, how easily are they recycled and on that kind of stuff. So for me, currently, the jury is out. I bought a car in 2019 that in a probably a more unusual move than what most people do. I bought it thinking I want to keep hold of this for 10 years. And that's exactly the plan. I have no plans on budget at the moment. It's a Skoda. It's a workhorse. It's very good. It's very economical. It's big enough for a family to throw all of the absolute kit and caboodle that you need for running a toddler household. And I'm happy with it. But at the same breath of that, I totally understand why people are buying electric. And I think I'm not going to sit here and say, don't buy an electric car. Go and do the research yourself. If you're in the market for a new car, go and have a look at the pros and cons. Potentially take one on test if you can, see how you get on with it. I've driven electric cars. I've had a couple on test, and I think they're an absolute joy to drive. They're quiet, they're smooth. there's a few things that hold me back. For example, charging it twice when I had one on test last year. I'm in the queue for the chargers at a motorway service station were like 20 cars deep. And when I finally did get to charging it up, the screen didn't tell me how much it was going to cost, what was going on. I had absolutely no idea until I went in the services, came back out, and then there was like a 35 quid charge or whatever it was. And I was like, well, I had no idea how much that was going to cost. It's not a problem.
Yeah.
But it's just lots of little bits and pieces that just aren't quite there for me at the moment. But I reckon probably in 2 years' time, and the infrastructure is going to be vastly different. I'd like to think that the price point of some of these cars is going to be coming down. If you think about something like the Ford Fiesta, for example, and a phenomenally popular car in recent decades, and that's the petrol version of that has ended. So what's the alternative? What's the Ford Fiesta going to be like? The electric alternative to that Fiesta. That kind of market, it feels like for me at the moment is lacking somewhat. But if you're someone, I was having this conversation with a colleague yesterday talking about taking a driving test. I would fundamentally now be thinking to myself, I'd be quite tempted just to take an automatic driving test, for example, because the way that the world's changing. Electric cars, you're not going to be needing to use a manual gearbox. So there's going to be lots of little things and nuances and things that are going to change on our roads in the coming years. I have no plans for an electric car before 2029, but I'll let you know if anything changes.
Well, we'll find out, Leo.
What about you, Georgie? What about you? You going to get an electric car?
I did exactly the same as you. 2019, bought a car, Vauxhall Mocha. There it is. I can see it now. There she is. Workhorse, driver to the ground. No, right now, no. All the stories I hear, the range anxiety, and I only really use it for long journeys to go to really Derby to watch the football or to see my dad a couple of hours away. If it's a pootling around car, fair enough, I might think about an electric, but like you, Lee, I'm not convinced about the green credentials at the moment anyway. So, that's me. Jury's out. I'm not in the market, so I'm not really thinking about it too much.
Can I offer something in the defence here of the prospect of buying an electric car as a man who owns 3 cars and none of them are electric, to a petrol, one is diesel, and all of them have considerably more. All of them have more than 100,000 miles on the clock. In fact, between the 3 of them, I'll just do the maths in my head. I reckon 220. Oh yeah, probably like 370,000 miles in total on the 3 cars. That's a green car, that is, because the environmental cost of building that car has been spread over a very long amount of miles. But if you are the kind of person who isn't like me, and you are the kind of person who might go out and buy a 3-year-old car or even a 1-year-old car, I think what's really interesting now is the amount of choice that you have of electric cars, which is like way, way different to what it was 3 years ago. Manufacturers have launched enough of these over the last, few years that you've now got quite a good choice of second-hand electric cars. Once upon a time, your choice was Tesla, Nissan Leaf, Renault Zoe, and there wasn't much else. Okay, now you've got a lot of choice. And also, if you compare them to maybe the equivalent petrol or diesel car, some of the used car prices have fallen by so much that you're looking at an almost comparable cost of buying them. So, for example, you can pick up an I-Pace for the same price as a Jaguar F-Pace, and you're going to save a lot of money on the cost of running an I-Pace if you've got a home charger and you can charge at home. And so it does start to look quite interesting from a financial point of view. It's just whether people are convinced that they want to buy that electric car, which, many people aren't. They do, as you say, they see it as more hassle. But you talk to owners, many of the owners are very, very happy.
Many of the owners are very, very happy. I'm sure they are. Many petrol owners are very happy. Well, it's up to you. We just offer you the research and the stories to make you make your own choice. Anyway, you can keep up to date with all the latest breaking money news. Just go to thisismoney.co.uk or download the app. And if you have any comments or questions for the team, anything you'd like them to look into, Simon.
You can email us at editor@thisismoney.co.uk. You can tweet us at thisismoney, or you can come to thisismoney.co.uk/podcast to find all podcast paths and join the debate and read the comments. And if you do own an electric car, or you've bought one recently, or you've had an electric car and then you switched back to petrol, email us at editor@thisismoney, stick podcast in the subject line so that we can easily find it. We would be interested in hearing what you have to say, from the ownership and buying perspective, because it's always good to get the views of real life people who are actually doing this stuff.
Indeed it is. And if you like our podcast, why not rate us wherever you found us? It helps other people find us too.
Don't forget, you can stay on top of what's going on in the markets by tuning in to the Digest and Invest podcast by eToro. Go to your regular podcast platform and listen on the go. Digest and Invest by eToro, the podcast for those interested in trading and investing.